return on investment is the concept of an investment of some resource yielding a benefit to the investor. A high ROI means the investment gains compare favorably to investment cost. As a performance measure, ROI is used to evaluate the efficiency of an investment or to compare the efficiency of a number of different investments. In purely economic terms, it is one way of considering profits in relation to capital invested. Purpose: in business, the purpose of the return on investment metric is to measure, per period, rates of return on money invested in an economic entity in order to decide whether or not to undertake an investment. It is also used as indicator to compare different project investments within a project portfolio. The project with best ROI is prioritized. ROI and related metrics provide a snapshot of profitability, adjusted for the size of the investment assets tied up in the enterprise. ROI is often compared to expected rates of return on money invested. ROI is not net present value adjusted, and most school books describe it with a year zero investment and 2 to 3 years income. Marketing decisions have obvious potential connection to the numerator of ROI, but these same decisions often influence assets usage and capital requirements. Marketers should understand the position of their company and the returns expected. In a survey of nearly 200 senior marketing managers, 77% responded that they found the return on investment metric very useful. Return on investment may be calculated in terms other than financial gain. For example, social return on investment is a principles-based method for measuring extra financial value relative to resources invested. It can be used by any entity to evaluate impact on stakeholders, identify ways to improve performance, and enhance the performance of investments. Risk with ROI usage: as a decision tool it is simple to understand. The simplicity of the formula allows to freely choose variables, for example, length of the calculation time, if overhead costs should be included, or details such as what variables are used to calculate income or cost components. To use ROI as an indicator for prioritizing investment projects is risky, since usually little is defined together with the ROI figure that explains what is making up the figure. When long-term investments take place, the need for net present value adjustment is high. Similar to discounted cash flow, you should use discounted ROI instead. Calculation: for a single period review, divide the return by the resources that were committed. Return on investment equals a 100, net profit equals gross profit expenses. Investment equals stock plus market outstanding plus claims, or return on investment equals / cost of investment, property purchase. Complications in calculating ROI can occur when real property is refinanced, or a second mortgage is taken out. Interest on a second, or refinanced, loan may increase, and loan fees may be charged, both of which can reduce the ROI, when the new numbers are used in the ROI equation. There may also be an increase in maintenance costs and property taxes, and an increase in utility rates if the owner of a residential rental or commercial property pays these expenses. Complex calculations may also be required for property bought with an adjustable rate mortgage with a variable escalating rate charged annually through the duration of the loan. Marketing investment: marketing not only influences net profits but also can affect investment levels too. New plants and equipment, inventories, and accounts receivable are three of the main categories of investments that can be affected by marketing decisions. See also, bang for the buck, rate of profit, rate of return, also known as rate of profit or sometimes just return, is the ratio of money gained or lost on an investment relative to the amount of money invested. Return on assets, return on net assets, return on capital employed, return on invested capital. Return on marketing investment is the contribution attributable to marketing, divided by the marketing invested or risked. Return on equity, return on event is a term used in event marketing, compared to rate of return ROR, also known as return on investment ROI, which is the ratio of money gained or lost on an investment. ROI for information technology is used to evaluate applications, portfolios and information systems. Public ROI is used to evaluate initiatives in the public sector. ROA, RONA, ROC, and ROIC, in particular, are similar measures with variations on how investment is defined. References: as of May 1, 2012, this article is derived in whole or in part from Faris, Paul W. Neil T. Bendel, Philip E. Pfeiffer, David J. Rebstein. Marketing Metrics: The Definitive Guide to Measuring Marketing Performance. The copyright holder has licensed the content utilized under CC by SA and GFDL. All relevant terms must be followed.